Welcome to Portfolio Casts, the podcast where we break down real investor portfolios using publicly available data.
In this episode, we're analyzing Ruane Cunniff from Sequoia Fund based on their latest reported 13F filing, exploring the key holdings, portfolio concentration, and what the positioning might tell us about their thinking.
Mike, we are looking at a portfolio today that carries some serious weight in the investing world. This is the Sequoia Fund, managed by Ruane Cunniff and Goldfarb. It was actually started back in 1970 because Warren Buffett himself recommended Bill Ruane to his own investors. We are talking about a $3.7 billion portfolio that lives and breathes classic value investing.
It is a legendary name for a reason, Sarah. They follow those strict Graham and Dodd principles. They look for high-quality businesses with massive competitive moats. They don't trade often. They run a very concentrated ship. Right now, their total gains are sitting at about 1%. It is a steady, long-term approach rather than chasing daily high.
You mentioned concentration, and nothing proves that more than their top holding. They have over 18% of the entire portfolio in one name. That is Rolls-Royce Holdings, trading under the ticker RYCEF. Mike, 18.2% in a single stock is a massive statement.
It really is. They own over 41 million shares. The total value of that position is over $707 million. Rolls-Royce has been a fascinating turnaround story. People often forget they aren't just about luxury cars. They are a powerhouse in aerospace and defense.
And the numbers seem to back up that conviction. The stock is currently trading around $16.88. Even though it saw a small daily dip of 0.42%, the fund is up over 5% on this position overall. What do you see in the fundamentals there?
The price-to-earnings ratio is sitting at 17.6. For a global leader in engine technology, that is quite reasonable. Their earnings per share are 68 cents. They also pay a modest dividend yield of 0.87%. It is a classic Sequoia play. They found a core industrial giant and they are letting it ride.
There was some recent news about their leadership too. CEO Tufan Erginbilgic, who people call Turbo Tufan, just received a multi-million-pound pay boost. It reflects the aggressive restructuring he has led. Sequoia hasn't touched this position recently. No buying, no trimming. They are clearly comfortable with the current trajectory.
They certainly are. It remains their cornerstone. It is the definition of a core holding.
Let's shift gears to their second largest position. This one is much more of a household name. They have 7.6% of the portfolio in Alphabet, specifically the class of shares. That is worth about $390 million.
Alphabet has been a huge winner for them. They are up over 39% on this position. It is trading at $338.25 right now. Even with the recent tech volatility, Alphabet gained 0.67% today.
The valuation is a bit higher than Rolls-Royce though. The P/E ratio is 32.6. Does that give you any pause for a value-focused fund?
It is higher, but you have to look at the growth. The earnings per share are $10 flat. That is incredible scale. Alphabet is also trading near the very top of its 52-week range, which tops out at $342. They haven't added to the position lately. They are simply harvesting that 39% gain.
It's interesting to see them hold a tech giant alongside heavy industry. But their third largest holding is where things get really unique. They have 7.8% of the fund in Formula One Group, or FWONK. That is roughly $239 million.
This is the one that might keep them up at night. Unlike Alphabet, they are actually down 16.5% on this position. The stock is currently $87.21. It dropped nearly 1% today.
That 16% loss is a tough pill to swallow, especially when you look at the P/E ratio. It is sitting at a staggering 132.2. Why would a value fund stick with such a high multiple?
It's about the unique nature of the asset. Formula One is a global monopoly on a specific type of entertainment. The earnings per share are only 89 cents.
We saw some news from the Longleaf Partners small cap fund mentioning Formula One as a detractor recently. It seems Sequoia isn't the only one feeling the pressure here. Yet, they haven't sold a single share. They are holding 2.7 million shares steady.
That is the Sequoia way. They don't panic when a high-conviction pick hits a rough patch. They believe in the long-term cash flow of the racing circuit. Even with a 132 PE, they are looking at the brand's moat.
It is a bold mix. You have the industrial stability of Rolls-Royce at 18%. Then you have the tech dominance of Alphabet. And finally, this high multiple bet on Formula One.
It shows they aren't just looking for cheap stocks. They are looking for businesses that can dominate their respective fields for decades. Between these three, you have over $1 billion of capital. That is nearly a third of their entire portfolio in just 3 names.
The discipline is what stands out to me. No recent activity across any of these top 3. In a world of high-frequency trading, they are standing perfectly still. They are watching these companies execute.
Exactly. They are waiting for the values to be realized. Whether it is the turnaround at Rolls-Royce or the continued AI expansion at Alphabet, they have built a foundation here that is very distinct. It is concentrated, it is heavy on conviction, and it is definitely not following the crowd.
Mike, we've spent some time on the history, but let's get into the heavy hitters currently in the Sequoia Fund. I'm looking at Charles Schwab Corp., which makes up about 6% of the total portfolio. They recently trimmed that position by nearly 9%. What do you see there?
It's interesting, Sarah. Even with that trim, they still hold over 2.3 million shares worth about $238 million. Charles Schwab is a classic Sequoia play dominant market leader. They actually just declared a 19% increase in their quarterly common stock dividend. That brings the yield to 1.04%.
Let's pivot to Taiwan Semiconductor Manufacturing. This is another massive name, representing over 5% of the portfolio. They trimmed this one slightly as well, by about 2.5%.
Taiwan Semi is the backbone of the global chip industry. The position is worth about $230 million. Even with this slight reduction, they are sitting on an overall gain of 21.6%. It's a powerhouse. Recent news suggests that AI is driving a great leap forward for the industry.
But the price tag is high. $339 a share?
Yes, and the P/E ratio is around 27. But look at the earnings per share, $66.25. That is massive. They're also paying a 1.13% dividend. It's a classic wide moat business that Bill Ruane would have loved.
I want to talk about the biggest move I see in the data. Elevance Health. They increased this position by over 27% recently. That is a bold conviction play.
It really is. Elevance now makes up 4.7% of the portfolio. That's about $185 million. What's fascinating here is the valuation. The P/E ratio is only 13.8.
So they are finding value in healthcare?
Definitely. The stock is at $346, which is well below its 52-week high of $458. There's a lot of room for a rebound there. Plus, they get a 2% dividend yield while they wait.
Now, it hasn't all been smooth sailing. I'm looking at SAP SE and Constellation Software. Both show significant overall losses in the portfolio. SAP is down over 25% for them.
That hurts. SAP took a 15% hit just today. It's currently at $200. Constellation Software is even tougher to look at, down nearly 30% overall. It's a high-priced stock at $1,902.
Does that worry you for a fund like Sequoia?
They are long-term players, Sarah. They don't jump ship just because of a bad quarter. However, seeing Meta Platforms reduced by 64% tells me they aren't afraid to take profits when a story changes. They sold a huge chunk of Meta, yet they're still up slightly on the remaining position.
We also see some classic Buffett-adjacent holdings. Berkshire Hathaway is in there, along with several Liberty Media entities like Liberty Broadband and Formula One Group.
It's a nod to their roots. Even though Berkshire is only 1.1% of the portfolio now, it represents that fundamental value philosophy. They also have a massive 55% gain on Momentum Holdings, which is a standout performer for them.
As we wrap up, Mike, what is the big takeaway for our listeners regarding the Sequoia Fund today?
This is a $3.7 billion portfolio that isn't afraid to be different. They hold concentrated positions in high-quality firms like Universal Music Group and Intercontinental Exchange. They aren't indexing. They are making specific, calculated bets on management and competitive advantages.
It's a reminder that even in a volatile market, sticking to those Graham and Dodd principles can keep you grounded.
Absolutely. They manage through the noise. They focus on the cash flow and the long-term moat.
Thanks for the deep dive today, Mike. It's been a fascinating look at a legendary fund. For everyone listening, thanks for joining us on this analysis of the Sequoia Fund. We'll see you next time. Thanks for listening to Portfolio Casts.
This content is for educational purposes only and should not be considered financial or investment advice.
Any figures, prices, or portfolio values discussed are approximate, based on public filings and used for illustrative purposes only.
The views expressed are interpretations of public information and may not reflect the investor's current positions.
Follow Portfolio Casts for more investor portfolio breakdowns.